Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome to the Mortgage 101 podcast, where we talk about finance, goals, and success with all things mortgage lending. Our job is to get you confident and get you out there knowing exactly why you're doing it, how you're doing it, and more importantly, what you're doing. So without further ado, Manley Haynes, how are you, buddy?
I'm awesome, Anthony. How are you doing today out in Hawaii? Having some fun in the sun.
You know, it's sunny and 75 at all times. We do have issues out here. I mean, I got what is it called? Sand in between my toes, and I can't feel my arm because the drinks are cold. I mean, it's really bad.
we had some crazy weather here. Last Friday, it was 78 degrees here, and on Sunday we had snowstorms. So,
oh, no way.
We're in the wild, wacky March, high winds, crazy weather. We could get snow and 70s in the same day. So
wow,
that's where we're at over here in Wisconsin. So yeah, but
well,
happy to be here. Happy to talk about mortgages with you again. And again, our purpose is to just talk about mortgages, bounce stuff off of each other, try to enrich people's education to the mortgage process, and that's our goal.
Yeah, I mean, at the end of the day, especially nowadays, if a client is not shopping with confidence and education, you know, they're flying blind. There's so much miscommunication out there, and it's up to us, the professionals, to dispose what's real and what's not real, what's actual and what's not factual. And so, you know, with this podcast, our job is to do a deep dive into some of these questions so that way, you know, they come away feeling more empowered to make decisions that are going to change the whole trajectory of their lives. So that's what we're doing this for.
Knowledge is power. We got to teach them. We got to let them understand what's real and what's not. You got it. Hit it right on the head, Anthony. That's why I love talking with you about this stuff.
Yeah, man. Hey, so what you got on the books?
What do you got? I want to hear some of your great things that happened this week with some of your clients. Give us a couple big wins that happened for you. Or one big win.
You know, 100%. I mean, a lot of my I had a client today over the weekend. They got their accepted offer, and the reason why they got their offer was because over the weekend there were 7 different offers that were submitted, but because the realtor CC'd me on the offer, and I was able to reply with a list of everything that's been done, as well as a video to show them that this client's not just pre-approved, but fully underwritten approved, verification of employment, income, assets, everything was done. The seller was able to look at that and go, okay, I feel more comfortable with this one. And we weren't even the highest offer. We were just the offer with the best communication. And oftentimes that's what takes the cake. And so, yeah, that was a big win for us. The fact that we weren't expecting the offer to get accepted because we were kind of a little bit under asking, but because of our communication and the level of communication, the listing agent was like, yeah, the seller feels more confident with you guys. We're opening up escrow.
That's a great best practice to really pin down here, is that communication to the seller upon the delivery of the offer immediately, as fast as possible, to give them the education and the level of confidence that they have a good lender on the other side is super important. And that's one of my best practices. I'm not as good as doing the videos like you are, so that's something that I'm working on my craft and tuning up to do that as well. But that's awesome. I had a crazy one that happened last week, and I kind of leaked this story to you last week when we spoke, but it's worth talking about, and it's worth something talking about for Rate, who we work for, and you know how powerful we are. We have this product called Smart Underwrite. I had a past client fill out an application again to purchase a new home, and they filled out the application, and I called and reminded the client to check their task list. They had a couple things that they could do quickly, and I just reminded them and said, hey, hey, do you mind jumping in there and connecting your asset accounts through our Finicity? It's super safe. We don't actually get to go into your accounts. You go into your account and we follow with you, and you give us access to see your bank statements and all your history of that account. And through that, we were able to do some AI smart underwrite that validated his income. He's high credit score, over 800 credit score, 17 years at a W-2 job. So it was very simple to validate, the income through the Finicity. And then through that, I got him to link within a couple minutes. We were there. I was able to then call my smart underwrite team. They jumped in the file, and literally within an hour, I had an approved loan, Anthony. I had an approved loan that you could take out on the street and shop like you're shopping with cash. It was from start to finish. It was less than 2 hours by the time the customer, filled out the app and then connected with Finicity after a polite phone call from me requesting that he check his task list, and he was absolutely happy to do it, and then get our smart underwrite team on the horn, and boom, we had a fully approved loan. All I need is an accepted offer within the parameters that we set, and we overshot the mark by a mile on purpose. So he can go up to the conforming limit right now, and he's good. Super simple.
Yeah, for our listeners, that's pretty big, because the traditional way is send your taxes, send your pay stubs, send your W-2s, go through underwriting. Whereas, you're talking days and you're talking paperwork. Whereas with technology, where it's headed, with everything being automated, you are able to do all of that within an hour, which is huge, not only with the borrower, because now the borrower feels confident going into any offer they're doing, but it's also confidence for the seller on the other side of the transaction, because now they know that they're not just pre-approved, they're fully approved, and you can give that full approval confidence, which is the difference that correlates to what happened over the weekend. The fact that I was able to, take the time and get them pre-vetted out before, which took hours and took a lot of paperwork. Whereas with you, when they did that application and they, signed up for that Finicity where everything is set up online automatically, that's a game changer, because
we can close in 10 days now, Anthony. We literally need the accepted offer. We need an appraisal. We may get an appraisal waiver because they're putting a sizable down payment down. And then we need clear title, homeowners insurance. So we are ready to rock and roll. This smart underwrite is a game changer. Now, granted, this isn't going to work for every loan that we get. We're not going to get the same hits. The Finicity is the key. But again, it's worth it to work with your lender, do what he requests you to do, provide the documentation or the connections that he's asking you to connect to get you that opportunity. Because if it happens, it's magic. Boom, we got an approved loan sitting there right now.
Yeah, that's great, man. That's where we're headed to, right? I mean, right now, typical escrows are 30 days, and there's going to be a time within the next couple of years where give us 10 days. That's all we need. And that's just the logistics of, getting the docs out to the title company and ordering the appraisal. So yeah, no, I'm looking forward to, and that's the beautiful thing about technology is it's always constantly improving. They're still going to need people like you and I that are going to have to be at the helm, right? Because we're the ones who can kind of put all this technology together to package it. So you're definitely going to need some expertise like myself and you, Manley, to make sure that what we're doing is going down the right way and the right path. And but man, that's a great success story. And I too am seeing a lot of that with more and more of my applications coming in, seeing that the income's already confirmed, the assets are already confirmed, and the less the paperwork, the faster the results. And that's what we want for our clients, right? We just want efficiency, and we want know-how, and we want confidence.
Confidence is the key, and if we can build it through something like that, it's amazing.
Yeah, man.
Hey, I got a couple what things that I want to chit chat about here that are things that you should not do while you're under contract. And I just wanted
Is the list long? You got to like 5,000 things of what you shouldn't do, or
no, I got a couple. I got a couple key points and things that have happened in my career that I could tell a story about each one, but I want to throw them at you and hear your story too. And the first
You've
one
been doing this since the 60s, right? I think you've been licensed for, I think this is the 57th year. So,
something
I mean,
like that. Something like that.
just congratulations, Manley.
Just coming up on 24. Just coming up on. But hey, borrowers, when you're in the throes of all this, please do not take on any new debt. What does that mean?
New debt. I'll tell you what it means. It means don't be giving out your information to get the Ashley furniture or the RC Willie credit card out. Don't be getting that red sports car, or don't be going to finance that pool that you're going to be putting in the backyard, or basically do not get anything until you're closed. I can't tell you how many times that happens where we get alerted, via email, bing, oh, John Doe just got his credit pulled for a $50,000 line of credit. It's like, and how does that affect them, Manley? Talk to us about how that affects them.
So that's a really negative impact that can occur, and it can be a deal stopper, and it can actually crash a loan into the ground. But there are things that happen in this process that you might need to talk to your loan officer and say, hey, I got a problem here. My car broke down and I need to get rid of my car and get a new car. And so, great. If we do that, it's just about the paperwork and obtaining all the information. If you let your lender know and you had 15 days till close and your car broke down and you needed to buy a new car, great. As long as the payment doesn't change too much, it's just paperwork. And so if you're willing to go through it with your lender and provide what's needed to get you to the other side, easy peasy. But I have had it happen where somebody came to the closing table and repeatedly said that we need to step outside and see her new red vehicle that she just bought on the way to the closing. And it was a showstopper. We were able to recover a week later after doing the paperwork to get it back in order. But it's a problem. But that's one of them. That's a good one. The next one, and this actually happened recently. Hey, borrowers, what's super important is your debt to income ratio, and your debt to income ratio comes from your income that you create by your job. And I had a borrower a week ago. 2 days before closing, they had been clear to close for 3 weeks. We did our normal verification of employment to make sure that they're still employed, and it's a verbal verification through their employer to say, hey, yeah, they're still employed here. And
when do you do this? When do you do this verbal? Do you do that in the beginning only? So
no, this is within the last 10 days of the loan. It's a backup. You do a verification at the beginning, but we're also going to verify 10 days prior to close. So we can do that up to 2 days, up to 1 day. It's typically 2 to 3 days out. Our team jumps out there and makes a phone call and confirms that they're still employed.
Well, why would they do that? Why would they do that?
You're going to hear why. You're going to hear why. This particular borrower, and didn't tell me this, we had to find out the hard way, quit their job. And so it crashed our deal. We were able to recover, and they were able to regain their job and get us back in good graces. But it was 24 hours of, holy cow, did this really just happen? And the conversation was like, well, I thought we were finished. You're not finished until you close. That's the important part. The day after you close, I'm not telling you to go do this, but we're done at that point. But just because we're clear to close, until we actually sign the documents and money have transferred hands, we need to make sure that we're not adding new debt. We're not taking on, we're not making large deposits. We're not quitting our jobs without talking to your loan officer. If something happened throughout the process and you need to quit your job because you have another job lined up, that's a conversation. Talk to your loan officer. That's the key. That's what I'm trying.
So what I'm hearing, Manly, is it's one, don't go out there and get a sports car while you're in escrow,
Yep.
and two, don't quit your job.
Your job.
So, I mean, for all y'all listening out there, that's pretty basic. I mean, if you're out there buying sports cars or you're out there quitting jobs during you're buying houses, you are asking for that smoke. And so you are asking for it because, but you'd be surprised.
We were able to recover, but it was a lot of drama, and there were some tears being shed, let me tell you. And
you'd be surprised. Like, these are normal things that we're talking about. Like, you would think, what rational person would quit their job? But again, they're thinking, hey, congratulations, you're approved. They think, hey, I'm done. Like, I can go do whatever I want. So that's why it's really important that we not only educate them, but we show them the whole roadmap from start to finish and the expectations on that roadmap. So that way they're not, messing it up midstream, thinking that, hey, I'm approved already. I can quit this job and take off a month or two and then get another one. Or, hey, I'm approved already. I can get that sports car I've always wanted. Because most likely, if people are buying houses, they're doing good in their lives, whether it's credit or whether it's finances. And so usually comes, windfall of buying houses, buying cars, buying extra stuff. So yeah, it's super important. The communication is back and forth.
Yep. Again, it just boils down to, if something has to happen, talk about it. Talk to your loan officer so we can prepare correctly and present the picture correctly to divert a catastrophe. That's it. Super simple.
Yeah.
Communication.
I agree.
Okay. Hey, did you want to just go over some basic loan terms for our folks out there and just sort of educate people on what the very basic foundation of building a loan file looks like and what you need to do?
Yeah. I mean, basically, what you want to know is the acronyms DTI and LTV. Those are the big ones, right? A lot of people hear DTI, or debt to income ratio, or LTV, loan to value, and they don't really understand how it affects their loan and what it means. And so, DTI, you got two debt to income ratios. You got a front end and you got a back end. And it's real simple. The front end is your housing payment, meaning how much is your housing payment compared to your income. And then your back end is your housing payment and all the rest of the debt that you have compared to your income. And so we have some rules depending on the type of loan product, whether it's FHA or conventional or VA or jumbo, non-conforming, all the other things in between. And so there's a bandwidth of what we can work with. Typically, you don't want to be over 47% with FHA, and you don't want to be over 50% with conventional for the front end, meaning your mortgage payment. So if you make it really simple for our viewers out there, say you make $4,000 a month. You traditionally can't have more than a 47, so you're looking at around $1,850 is what your payment's going to be max on $4,000 a month. And then that's your front end. Your back end is your mortgage payment and your credit cards, student loans, child support or alimony, your car payment. And so they add that to the list. And then typically for FHA, you can't be more than 56.9. For conventional, you can't be more than 50. And for VA, I've done some as much as 70% with compensating factors. So it's really important to understand that. So that way you can get a good grasp on what does my income look like into relation of what my mortgage payment is going to look like on top of all of my debts. And it's an eye opener for a lot of people because they're like, how come I can only afford a $300,000 house? And I'm like, well, it's because you got a $1,300 car payment. And that's basically a mortgage payment that you have on your debt to income ratio, right?
Yep. See that on a regular basis. And people, when you take them through the conversation, a debt to income ratio was what we're talking about again, and how important it is to understand what all your other debts are other than your all-in housing expense, which is your principal and interest payment, your homeowner's insurance payment, your property tax payment, and possibly mortgage insurance payment if it's required on the product. Knowing the product is key, though.
And here's a cheat code for you. You know, when you're going to buy a house, you know, you can use your 401k. And, you know, a lot of people, they look at it and go, well, I'm taking away from my retirement. But when you look at it apples to apples and you go, okay, my 401k is making 6 or 7% yield. If you take 50,000 out, you're displacing that. And now you're putting it in where? Well, you're putting it into a $400,000 house where if you add all the pillars of paid down principal, appreciation, tax incentive, cash on cash, you're almost double digits. So would you rather make 10% on 300,000 or 6% on 50,000? So that's why they allow you to take money out as a primary residence, because they know it's economical. But I love when I see someone where they're like, well, Anthony, I have like $1,500 a month in debt. That's like 50 grand. And they were going to pull and put 20% down on a house. And I tell them, why don't you just put 5% down and take the other 15% and pay off all the debt? And, you know, now you have no debt and you're in a lot better situation because your debt to income ratio has gone way down because you've leveraged the assets that you have at your disposal. These are the things that you and I talk about. We look at the big picture, not the small picture, for the benefit of the client.
And that's the best part. You need to understand the big picture from the financial standpoint so you can pull those triggers and do that math for people to let them understand that there's more than one way to skin this cat. And understanding, you know, where your assets are, what they're doing for you. Not that we're financial advisors, but we do have a good understanding of what, why, and when it's important to be able to do that. And you're talking my language repeatedly when we're talking about being able to build wealth through buying your home, $400,000 asset, and being able to let that grow at just from an appreciation standpoint. But all the other aspects of that you're pointing out are massive, and it throws that number completely out of whack to a good thing. Other than, you know, your normal rate of appreciation, 6 to 9%, something like that. National average is, I think, 7.5 or something right now, in that range.
Yep.
But super important.
Yeah, it's important. And, you know, mortgage is a language, and it's a language that a lot of people don't understand. Just like if, you know, my other friends from other countries start talking to me in their language, I'm going to be like, I have no idea what you are saying. But if they talk English, I know exactly what they're saying. The same thing is when it goes to mortgages. We have a language, a financial literacy mortgage language that you and I know because we see it. We're kind of like Neo when we see like the green, you know, the green numbers coming down in code. That's how we're looking at someone's mortgage. They're looking at it as, what's my payment? What's the rate? And that's all they basically see. Yeah. We're looking at it at a complete different aspect, a more logistical, a more forensical, a more economical approach to say, not only are we looking at your mortgage, but we're looking at everything that encompasses it on a mathematical level that they're not even thinking of. So as a mortgage lender, we have to answer questions before they're asked because we've been down this yellow brick road. You and I skip down it every day. And so Dorothy hasn't, and John Doe hasn't. And it's up to us to let them know what's ahead. And so that way they can prepare because, again, what they don't know scares them and the unknown scares them. So the more knowledge we give them, then the more empowerment, the more confidence they have to where our clients, when they go for a house, they know their payment, they know they're out of pocket, they know what an amortization schedule is, they know what type of loan they're doing, they know what encompasses it, they know where the economy was, they know where the economy is, they know where the economy is going, and they are fully prepared in making, you know, the biggest decision of their lives.
That's great stuff. That's great stuff. Well, that's just one little factor that we have to think about on the debt to income ratio. So thanks for clearing that up and giving us just some words of wisdom on that together. And hey, it's a big week for the feds this week. There's some Fed communication going on, so we don't have a ton of time here. If you just want to give me your 2 cents on that, I think you know they're saying the economy's not as stable as we had hoped, and we're gonna.
Are you? It's not. You what? It's not. I mean, everything is perfect. I mean,
Everything's rainbows and unicorns.
yeah, that's it's like show me what you know, and I'll show you your agenda. And it's like you have so much stuff out there that is so incorrect because it's based off of passionate thinking, not rational thinking. And at the end of the day, math doesn't lie, economics doesn't lie, jobs numbers doesn't lie. And so the smoke and mirrors, once it goes away, for people who are listening and they're like, I don't understand, like when I hear the interest rates are dropped and then I call my mortgage guy and they say the rates went up. And so there's just a lot of moving parts into this engine that we call the American economy. And you just need to know enough to be dangerous. And basically, when you see the stock market tanking, then you know the rates are going to be tanking. When you see the stock market booming, then you know the rates are going to be steady or going up. And at the end of the day, one person's spending is another person's income. And when people stop spending, that income goes away, aka unemployment rate goes up. So that's how the feds base the heartbeat of America is based off of how people are spending. Because if people are afraid that we're going into a recession or they just maxed out on their Amex, they're not going to be spending like they did. Whereas that means the people who are reliant on that spending are not going to be having clients or customers, and they're either getting laid off or they're shortened work hours, aka unemployment going up. And so basically, in a nutshell, what the feds are saying is, well, it's not as rosy as we were talking about in December. And yeah, we may have to do some adjustments because our calibration was wrong. And we knew this, but it was kind of like the tariff effect. They say something to try to get a reaction. And then if that reaction is not what they wanted, then the consequences happen. And that's how the feds work. The feds work on a forward-thinking trajectory. When the movement in the market happens, that's when the feds talk about it. When the feds actually do something, that's just a causation of how the American people reacted to them talking about it. Well, probably made your mind go crazy there, but at the end of the day, they're trying to subdue the American people into what they talk about in their meeting minutes. So that way, when it comes to actually making the decisions, it's not as big as a crash landing as possible. In other words, when they talk about the economy doing bad and people need to stop spending, they're hoping that people hear that and they stop spending. And if they don't, then they're basically going to not do anything about it. So in a nutshell, the feds are meeting this week. The jobs report is coming in a lot less bearish, and a lot less bullish and more bearish than what they were thinking. And so they're thinking there's going to be 3 rate reductions this year. Just to give you some examples, in January, they didn't even know if there's going to be 1. So within 60 days, they went from 1 to 3. So that's how much the pendulum swings. So it's a day by day, week by week, month by month calibration. But I will say to the people listening, we can just look back and we know that in 2023, the Feds raised the rates 9 times. And we know that inflation was over 9%. And then when we look at 2024, the Feds didn't raise the rates at all. And they actually lowered them twice. And then they said 2025, we're going to lower them even more. And if we look at 2026, that's probably going to be on the menu. So we know that behind us was nothing but rate increases. And in front of us is nothing but rate decreases. So what is that going to do to the rates? It's going to get them down. Are we going to see rates in the 2s and 3s again? Probably not in our lifetime. But are we going to see 4s and 5s? Absolutely. Is it going to take a couple of years? Absolutely. But what's going to happen is as these rates start going down, like we're seeing, the 3-year influx of people sitting on the sidelines wanting to buy are now going to come off. And now that supply and demand is going to tilt, which is what the government doesn't want. What they don't want is an influx of people jumping in the market, because what does that do? Supply and demand. Creates a high demand, lowers the supply even more. And what do we have? An explosion in values, which is not what they want, because that's what creates bubbles. So they have to be particular with the rates. They're not going to do it overnight, but they're going to do it systematically. So that way it's a leverage in for all these people waiting to buy houses.
We are in what's called a slow grind. None of this is going to be hot and heavy rates lowering. We may see, a 0.25% reduction in the Fed overnight fund rate. Is that going to immediately lower the mortgage rates by, 0.25%? No, it's going to grind its way down. And so,
Wait, so you're saying that? So you're saying that when the Fed rate drops 0.25%, doesn't the mortgage rate drop 0.25%?
It does not, my friend. They are two different products.
But that's not what the news said.
Unfortunately, the news gets this wrong every time they talk about it.
Whoa, hold on.
Overnight
You're saying the news
fund
is wrong? All right, I got to change this channel.
There's some misinformation at times that occurs, as you know. The Fed fund overnight rate is what banks borrow money back and forth to each other, and it affects consumers' credit cards and stuff like that. But it doesn't correlate directly to a mortgage interest rate, which is long-term debt. So short-term debt is Fed overnight fund rate. Long-term debt is mortgage-backed securities, mortgage bonds, or bonds in general. They don't walk hand in hand, but they do move with each other loosely. So the reaction from the Fed's reducing the interest rate will have an impact, but it'll take a long time for them to grind down to come down to the same level.
So basically so we see when we see the Fed rate go down, we know that trajectory is going to be for the mortgage rate, but they're not one and the same. So all you guys out there that you're going to see rate, 0.25%, and then people expect, my favorite is when it's out there and they're like, the Fed's dropped the rates, and they're like, hey, yeah, Anthony, I heard rates are at 3.5%. I saw it online. And if you can beat that, you got my business. And I'm like, oh man, if that's how it worked, then life would be amazing.
That's a really long, we could spend hours talking on this and probably, blow people's minds. At the end of the day, it's not as simple as, the Fed's lowering the rates and all of a sudden the magic interest rates for the mortgages come down to, it's not a magic beanstalk that's going in reverse. But anyway.
Yeah, I agree.
We've covered quite a bit of ground here today, Anthony, and there's more to come. There's more, deep dives we're going to take on other things coming up here in the future. But for right now, I think we've probably provided enough clarity and humor for these people. But the big takeaway that we want people to understand is, hey, please be confident in understanding what your mortgage options are and what they mean to you and what the process is going to look like throughout its entirety, and from cradle to grave, from start to finish, from the time that you get pre-approved, get an accepted offer, you close on that beautiful home you just bought, and the communication's key. That'll keep your confidence up. So.
Yeah, it's questions. You have to ask questions. Just as much as you're getting approved for a loan, you're getting educated. And so if anything, that takes precedence. The approval is the causation, and the after fact is education through that process. So, anyone going through the process of mortgage, make sure you ask questions. And if you get pushback on that, there's your sign. You may not be working with the right person if they're not open to any questions that you have, and they want to keep you in the dark and they don't want you to know too much. That's probably your sign to get off that crazy train.
That is correct. Well, great to have you here again, Anthony, and super stoked to continue this on to our next opportunity here coming up. We're going to try to get a frequent, steady pace of this so that we can keep educating consumers out there, so that they can have a better experience through the whole mortgage process.
Absolutely, brother. I appreciate it.
Thank you, Anthony. Good to talk to you today. Have fun out there in Hawaii while I'm looking for my next snowstorm.
Yes, sir. Appreciate you, Manley.
Thank you, brother.